What's up, everybody? This is Sunko, the Korean bro. Today is 2023, April 4th, right? Okay, let's see. Three top healthcare stocks to buy for April. Three stocks that doubled dividend income in the past 5 years. Two growth stocks to buy in April. Why some investors may be disappointed in Tesla's deliveries. Hmm. Um, okay, let's see one by one, okay? First, three top healthcare stocks buy for April. Johnson and Johnson keep its growth going. Okay. MasterCard lowers United Health growth. Netflix and Chewy. The bullish thesis for Chewy stock rests on the idea that its 2022 results represent a brief interruption to its longer-term growth story. Short, the pet supply specialist posted strong sales growth, improving profit margins. Its active shopper base shrank slightly in its fiscal quarter fourth, which ended January 2029, falling 1% to 20.4 million. Tree will bounce back. The e-commerce specialist enjoys incredible customer loyalty, with subscription-based sales accounting for 73% of the business in 2022, compared to 70% a year earlier. While recent price increases pressure sales volumes, they've bolstered the company's financial strength and demonstrated its ability to pass along its rising costs to consumers. The business might see more pressure through 2023 from a continued decline in discretionary pet purchases, but Chewy has already shown that it can generate solid profits in that type of environment. Looking further out, there's attractive growth opportunities, including a plan to expand into international markets. Meanwhile, investors can take advantage of Wall Street's short-term pessimism to pick up this growth stock at a discount. Shares are trading for just 1.4 times sales, down from over 6 times sales at the market's peak in late 2021. It's possible that its valuation will decline further in the near term, especially if economic growth continues to slowing. But the pet supply industry is less sensitive to recessions and other consumer niches, and Chewy has a good shot at leading the industry out of the current cyclical downturn. That's why growth of stock investors should take a hard look at the stock today. Hmm. Electric car maker Tesla announced some impressive vehicle delivery numbers over the weekend. Deliveries soared 36% year over year. Not only is this impressive in its own right, considering the uncertain and challenging operating environment, but it notably marks an acceleration in the company's previous quarterly growth rate. Delivery grew 31% year over year in the fourth quarter of 2022. So why did Tesla's stock price fall sharply on Monday, the first trading day after the deliveries were released? The pullback likely boils down to two things: high expectations and underwhelming growth in the context of Tesla's recent aggressive price cuts. High expectations and underwhelming growth in the context of Tesla's recent aggressive price cuts. Deliveries may not have lived up to Musk's recent comments. Tesla said on Sunday that it delivered a total of about 423,000 vehicles, but this is up significantly from the approximately 320,000 vehicles delivered in the year ago period. Maybe underwhelming figure in the context of Tesla's recent price cuts. Earlier this year, price for some models were reduced as much as 20%, while these prices cuts initially spooked investors and caused the growth stock to sell off. Tesla CEO Elon Musk calmed investors during a quarterly earnings call in January, noting that thus far in January we've seen the strongest orders year to date than ever in our history. He even said the current rate at which Tesla was receiving orders was almost twice the rate of production. Of course, these orders rates follow Tesla's price cuts, so there was a looming question how much of this demand would dwindle after price cuts faded into the rearview mirror. You know? Let's look at this one. C3.ai, three reasons to avoid this hot artificial intelligence company. Despite its growth potential, C3.ai's revenue declined in its most recent quarter. The majority of its business comes from the energy sector, making it vulnerable to crashing oil prices. After the stock tripled this year, its price sales ratio was crashed to 15. Everyone is talking about artificial intelligence these days. Thanks to the breakthrough of ChatGPT, the tech CEOs and pundits alike are convinced that artificial intelligence, in particular, generative AI, will be the next major computing platform. Well, unfortunately for investors, pure play AI stocks are hard to come by on the stock market, making it hard to know how to capitalize on this opportunity. That's a major reason why C3.ai has attracted so much attention on Wall Street. It's one of the few AI stocks available to investors with a model using a software as a service platform to deliver AI for enterprise solutions for customers. As a result of that surge of interest in artificial intelligence, C3.ai stock nearly tripled through the first 3 months of the year. Before you jump on the bandwagon with the high-flying AI stock, you should be aware of the drawbacks it's facing. Here are three reasons to avoid this stock at the moment. Isn't the high growth stock you think it is? The hype around AI and the attention on C3.ai in particular might make you think that this is a fast growing software company, but its recent research show that it's anything but the case. C3.ai reported a decline in revenue in the fiscal third quarter. Its most recent period showing it's facing the same kind of challenges most of the tech sector. In quarter three, revenue fell 4.4% year over year to $66.7 million. Dollars. This was partly due to the company's decision to change its business model from subscription based to consumption based, which has created some noise in the results. Hmm. Revenue is expected to decline slightly in the current quarter as well, but management said revenue growth would accelerate in its fiscal 2024 due to drivers like the launch of its generative AI platform, increased interest in the consumption based model, and new and expanded partnerships with businesses like Alphabet's Google Cloud. C3.ai is also losing money. It's on track for an adjusted operating loss of $69 million to $73 million this year. But management expects the company to be cash flow positive and profitable on an adjusted basis by the end of 2024. Those are big promises from a company that has struggled with execution, including the business model issues. And given the macroeconomic climate, investors shouldn't assume it will hit the guidance. Concentration is a problem. Most software companies tend to receive a range of interests across multiple industries. But C3.ai has struggled with diversifying its revenue sources. In fiscal 2022, 31% of its revenue came from Baker Hughes, the oilfield services company with which it has a strategic partnership. Its top three customers last year accounted for 58.7% of accounts receivables, a proxy for revenue. Its most recent quarter, 72% of its bookings came from the oil and gas sector. That makes it particularly vulnerable to a crash in oil prices, which is likely in a global recession as oil prices are hardly cyclical. The company has a lighthouse strategy of tapping into new industry by landing a flagship customer in that sector and then expanding to other customers in that industry from there. But while C3 AI also serves industries like banking, utilities, defense, and manufacturing, the revenue hasn't been sufficient to diversify the business away from oil and gas. The company finished its most recent quarter with 236 customers, though it's hopeful the consumption-based model can bring in more smaller accounts. Mm. C3.ai's valuation is based on hype. The stock's tripling in the first quarter was based almost entirely on hype around artificial intelligence, rather than any improvement in the fundamentals. Shares also got a boost at the end of January after C3.ai announced its new generative AI product suite, though it doesn't appear to be generally available yet. However, after the current run up in the price, the stock now traded at a price sales ratio of 15, though the first 3 quarters of the fiscal year, the company's lost $270 million on $174 million in revenue, indicating it's a long way from being profitable on a generally accepted accounting principle basis. Given those financials, investors seem to be bidding the stock higher on noting nothing more than the company's growth promises and vague notions about the transformative potential of AI. At this point, a bet on C3.ai seems like a more of a lottery ticket on artificial intelligence rather than a rational investment in a company whose future cash flow justifies its current price. Okay, the author strongly says that like spending money on C3.ai is like more like a lottery than spending something on logical thingy. Hmm. DigitalOcean, a cloud provider walking with giant. According to an estimate by Grandview Research, the cloud computing industry could be worth upwards of $1.5 trillion per year by the end of current decade. That's a big opportunity for one small provider of cloud services. Hmm. There's the ocean, which has a market capitalization of just $3.8 billion today. Competing with giant in the cloud industry such as Amazon Web Services and Microsoft Azure, which have the support of their trillion-dollar parent companies. But AWS and Azure make most of their money from larger enterprise customers. It's not economical for them to offer the same level of personalized service support and affordable pricing structure to small businesses, the way DigitalOcean can. DigitalOcean's customers, for example, spend an average of just $80.27 per month. Nautilus, it's a lucrative segment of the cloud market because it's expected to be worth $98 billion this year, and it could double to $198 billion by 2026. DigitalOcean generated $576 million in revenue in 2022, representing a compound annual growth rate of 29% since 2018. So we got DigitalOcean here. Mainly its competitor is AWS and Azure, but then Azure and AWS, their main customer is like big company, whereas the customer of DigitalOcean is a small business. So uh, the office provided by AWS and Azure are more tailored to uh, big company. It's not like they can change their service right away to um, fit into small business because there's a lot of energy involved. But then DigitalOcean is doing good in that perspective because they got their own customer pool. Hmm. Let's look at this one too. Confluent. Have you ever used a sports betting platform to place a bet during a live game? Or do you often walk into a Walmart store and find exactly what you're looking for every time? Delivering those convenient experiences takes a monumental technological effort behind the scenes. and Confluent is the company powering it. It's a leading provider of data streaming technology, and opportunity Confluent values at $60 billion today. By 2025, the International Data Corporation thinks 90% of the 1,000 largest companies in the world be using it, so it's worth paying attention. The technology allows businesses to draw real-time insights from data they generate through their cloud-based operations. For sportsbooks, data streaming is used to facilitate live betting. When an event occurs during a match, odds must be recalculated and pushed to the customer in a matter of seconds, several times per game. In one much case, the technology is used full inventory management. It links every physical stores and every online sales channel, so whenever a product is sold, it's quickly replenished before it runs out of stock. At the end of 2022, Confluent had 4,530 customers, including 991 spending at least $100,000 in its platform every year. Intuitive search for Meta platforms. Let's read it too. Meta platforms and PayPal Holdings because they're the ones that I have my money. Okay, first Meta platforms. Ken Griffin was also a big buyer of social media stock Meta platforms. The company formerly known as Facebook, Meta is a Citadel's largest stock holding. With Griffin and his team adding more than $5.61 million shares in the December annual quarter. The impetus buy was probably similar to Tesla. Meta stock took a dropping during the fourth quarter. Yet the company remains strongly profitable. At the end of the day, Meta owns four of the most popular social media sites, has more than 3.7 billion monthly active users, and usually possesses phenomenal ad pricing power. As U.S. economy rebounds, this ad-driven segment should only strengthen. Meta CEO Mark Zuckerberg is also listening to the voiced concerns of shareholders regarding aggressive metaverse spending. The midpoint of Meta's 2023 spending guidance was about $5 billion lower than previous forecast. Furthermore, Meta's board approved up to $40 billion in share repurchases. Oh. Even if the U.S. economy environment remains challenging, we should see tangible bottom line improvements for Meta this year. With shares of Meta platforms more than doubling from their fourth quarter lows, the real question will be whether Citadel Advisor unloaded a portion of its stake for profit during the first quarter. We'll have the answer by mid-May, which is when the 13 apps for the first quarter are due. Now let's go over to PayPal Holdings. Okay, the top performing hash fund was also buying fintech stock PayPal Holdings hand over fist. Ken Griffin's fund more than quintupled its existing stake by adding over 5.43 million shares. One of the more interesting things about PayPal is that while growth has slowed, it still managed to increase the total payment volume of digital platforms by a double-digit percentage in 2022. When you exclude the foreign currency movements, it suggests we're still in the very early innings of digital payment growth and adoption. As I've previously pointed out, engagement among its active accounts is on the rise too. In 2 years since 2020 came to close, the average active account completed 26% more transactions over the trailing 12-month period. PayPal is primarily a fee-based business that's driven by increased usage. If active accounts continue to utilize PayPal and Venmo in growing numbers, profits should steadily rise over the long run. The biggest question mark for PayPal at the moment is how quickly the nation's central bank can tame inflation. The longer the inflation rate stays above historic norms, the more likely its consumers will pare back their purchase activity. Well, since it's getting really late tonight, I'm gonna have to wrap it up. Been doing it for 90 minutes. I'll be doing it probably more tomorrow. Okay. See you and have a good night. Bye bye.